Hi everyone. Welcome to today's class. We're going to start now. Recording this class so others will find us on our way. If they can't join us, then they can go and check the recording. You can do the same as well. If you want to go and refresh and get some look at what we're doing today, the recording will be available after the session. So maybe the question is, how do I get the recordings? So if you use the same link, or if you go to the chat, if you have chat and you go to the previous session where we started recording, you will get the recorded session. You will get the recorded session. I've just shared the screen there. I hope you can see what I'm sharing. Before we proceed, if you have any question or you want me to repeat anything, you can use the chat. You can type on the chat, then I'll be able to see it and respond to it properly. This is class number 2 or session number 2. For those who were with us on Monday, we are busy with changes in accounting policies, estimates, and errors. This is a topic on its own, and from the accounting standards, it is International Accounting Standard number 8, and I believe that you started with this topic on level 2. I think on level 2 they were focusing on estimate and errors as then to be corrected, but what I know is that this is not a new topic to you guys. You've done this topic on level 2, and it is just the continuation. So all the principles that you've learned on level 2 are the same principles we're going to use at this level. But having said that, you will realize that in this topic, there are 3 parts to it. There is changes in accounting policies, estimate, and errors. So Monday class, we focused on change in accounting policy. And even today, we're still going to deal with change in accounting policy. And then next week, in our next class, we'll deal with estimate and errors. All right. Let's recap what we did last week or last Monday. We're still on the same week. So it is very important. It is very important that you understand what is expected from you guys when you're writing a test, exam, or any assignment. When it comes to this topic, what will be expected from you is that you should be able to prepare the state. Also, you'll be expected to prepare the statement of changes in equity. You will also be expected to know how to prepare a change in accounting policy note. Lastly, you will be expected to know how to calculate income tax expense and taxable income. The last part should be easy because we dealt with the topic of income taxes in detail. The principles remain the same. The principle remain the same. All right. Let's proceed. So again, while we're still recapping what we did on Monday, I've indicated that at this level or during this semester, when it comes to changing accounting policy, the focus will be on 2 categories, which is change in inventory valuation method, which we just did on Monday, as well as change in borrowing cost treatment. The change in borrowing cost treatment will be the focus for today's class. The change in borrowing cost treatment is going to be the focus of today's class. So today, on Monday, we dealt with inventory valuation. Today, we're going to deal with borrowing cost. The principles or the guidelines still remain the same. So the question is, when can the company change its accounting policy? The standard stipulates that a company can change its accounting policy if it is required by the statement of interpretation. What it means is that if the International Accounting Standard Board decide to revise or to change a standard, it can issue a communication to the companies and all those who use the standards to say, from this date, you must use the new standard. That's one way of looking at it. On the other hand, the company is allowed.
Yes.
On the other hand, the company is also allowed to change its accounting policy if that change will bring the reliable and relevant information. In other words, if it will be favorable for that company to present their books in using the new policy. Those are the two ways that the company can change its accounting policy. All right, we're almost done with the recapping and we'll go to the focus of today's class. We'll do the actual exercise. And I must say up front that the exercise that we're going to do today, it was tested last year in one of the tests. So the standard that you're going to see on today's class or example will be more or less what you can expect in the exam, in the test, or any assessment that you're going to be given. The standard will be the same. Why am I saying that? Because this example that we're going to do today, it is what was tested last year. So last year test, this is what was tested. So we're gonna go through it in detail. I'll explain the key issues. And again, I'm going to say it that make sure you understand it. Once you understand it, it doesn't matter what they bring to you. If you understand it, you will be able to solve each and every question that you can encounter at this level, as long as you understand what we're doing. All right, so let's move along. Change in accounting policy should be accounted for retrospectively. What does that mean? It means that if the change is happening in 2020 and you have information for 2019 and 2018, you must go back and apply the new change or the new policy as if in the previous years you were using that policy. That's what retrospectively means. Then the last part, how should we disclose the change in accounting policy? You should be able to disclose the nature of the change. What does this mean? So you must tell the users of the financial statement as to why is there a change? Why did you change your accounting policy? We will see when we go to the note today. Even on Monday, we did the same thing. Why did you change it? So you should be able to tell the users. Remember, when it comes to financial accounting, when you're preparing the books, you are preparing them for the users of financial statements. So you should be able to tell them, why did you change your accounting policy? Is it because the International Accounting Standard Board indicated so? Or is it because you as the business or the management of the business decided to say, by the way, if we change our accounting policies, this will provide us with more relevant and reliable information, which is allowed by the standards. The other part for the disclosure is that all the amounts of adjustment. So what would be the impact on the financial statement due to that change? You should be able to do that. And the last part is if it is not possible to apply retrospectively. In other words, if you don't have information from the previous years, then you must explain why you don't have information and you disclose it as such on the note. All right, today focus, borrowing cost. So borrowing cost is a standard on its own. International Accounting Standard number 23. And in this semester, there will be a topic called borrowing cost on its own separately. So what I'm going to do here, I'll just give the highlight of the borrowing cost. When we get through the topic itself, we'll deal with the details. So how does borrowing cost feature in change in accounting policy? So in order to put it clearly is that change in accounting policies, it goes hand in hand with all the topics or all the standards. On Monday, we're dealing with inventory. There can be change in accounting policy in leases. But what we say is that for this course, for these purposes, the change in accounting policies that we're going to deal with, it will be borrowing cost as well as inventory valuation. So in other words, is International Accounting Standard number 2, which is inventory, and International Accounting Standard number 23, which is borrowing cost. But later on, you will be exposed to borrowing cost in detail. So let me explain on a high level what borrowing cost is. I'm not sure if you've done it in level 2 or not, but nevertheless, that's not a problem. I'm going to explain as to what is borrowing cost. So the easiest way for me to explain what borrowing cost is, if you have a company that wants to build a shopping mall, they do all the budget and all the research, and they say they need 100 million rand to start constructing that shopping mall. And they realize that they don't have cash to the value of 100 million to use to build that mall. So what they will do is they will go and borrow the money. Normally they can go and borrow from the bank or any other financial institutions that fund such projects. So if they get that 100 million, that means that they will be paying interest on a monthly basis or yearly basis, depending on the agreement that they've signed. So there's a standard developed called borrowing cost for accounting purposes. And the standard simple states that when you have borrowed money, the interest that you're going to pay, you can either capitalize it or expense it. That's all. You will see it when you go to it. The interest relating to the money that you've borrowed, you can either capitalize it or expense it. So what is capitalization? I hope by now you know what is capitalization. We did capitalization on the components of PPE. So what it means is that from that 100 million rand, if you go and pay 10 million interest, you can either capitalize it or expense it. So if you capitalize it, then it means that whatever value of the asset that you're building, you're going to include that 10 million. In other words, it will form part and parcel of the assets. Hence, I indicated that it will be disclosed under statement of financial position. That is capitalization. You can decide to expense that 10 million of expenses. Then it will go to the statement of profit and loss. The details will deal with them on the borrowing cost. But this is on the high level. So we're more interested in the interest. How is the company treating the interest? Are they capitalizing it or expensing it? So when it comes in relation to changing accounting policy, this is what will happen. The company might decide to change that we were capitalizing our interest. Now we want to expense it. Or the other way around, say we're expensing it now we're capitalizing it. That constitutes change in accounting policy. This will be the focus of today's class. So whenever you receive information they're talking about borrowing cost, first thing first, you need to understand as to how was the company treating interest. First question we'll ask ourselves, were they capitalizing it or expensing it? So it has an impact. So if they move from capitalizing to expense or from expense to capitalize, it has an impact. It has an impact on our financials. That's where change in accounting policy comes into play. We'll see with the actual example in no time. We'll see with the actual example. But one thing I can say now is that if you understand this, you will never struggle. I can bet with you, as long as you understand this relationship, you will never struggle. You will always get change in accounting policy when it comes to borrowing cost or inventory, because you will understand what is happening. So borrowing cost, just to recap, we're more interested in the interest. How is the interest treated? Is the company capitalizing it or expensing it? These are the policies that they can choose. So if they were capitalizing it and now they decide to expense it, they've changed the accounting policy. Even if they were expensing it and now they capitalize it, they've changed the accounting policy. That's with regard to borrowing cost. So now, here is the critical issue. Let's say, for example, the company was capitalizing its interest and now they want to expense it. So this is what is happening. So if they're moving from capitalization to expense, that means that the expense is going to increase and the asset which they capitalize it to, it is going to decrease. It is easy as that. Here's the statement of financial position, statement of profit and loss. So the capitalization of the statement of financial position, we're talking about an asset that they were constructing. Normally, when you borrow money, you borrow it for constructions, for bigger projects. Like, for example, I've given an example of when you're constructing a mall. When you're building a mall, you will need money. And if you borrow money specifically for the project, then you can capitalize the interest or expense it. We'll see it clearly when we go to the examples, which will be the next slides. Here's an example number 2. As I've indicated, I just took this example straight from last year's test. This was tested last year. So let's start from the required, and then we'll go later and discuss the additional information and the other information provided. Let's look at the required. Very important. As I've indicated at the beginning, you should be able to know how to prepare the statement of comprehensive income, statement of changes in equity, and you should be able to prepare the notes to the financial statement. You will see in this example, the one change in accounting policy note, profit before taxation, and change in estimate. These two will deal with them next week when we deal with change in estimate. The focus for today is change in accounting policy in relation to borrowing cost. So here's the required statement of comprehensive income, statement of changes in equity, and the note, similar to what we did on Monday. Now, let's go and look at the information provided to us. We are given the statement of profit and loss for both 2018 and 2019. I won't go into the details. I believe at this level by now we all know how the statement of profit and loss and other comprehensive income, the structure part of it, how does it look like? Then additional information number 1 is dealing with the change in estimate. So I'm not going to attend to this today. This will attend to it next week. I'm more interested in this additional information number 2. All right. I'm going to read this additional information number 2, and from it we'll discuss about it and we'll see what type of calculations we can do. Additional information number 2 reads as follows. During the current year, the company changed its accounting policy with regard to borrowing cost from capitalization of borrowing cost on a qualifying asset to benchmark the treatment of expensing borrowing cost. This gives reliable and more relevant financing information, and they give us interest capitalized. They also give us finance charges, and they give us information from 2017 to 2019. This is very important. This is very important. So first thing first, let's try and find out what happened. What happened here? So initially, they were capitalizing their interest, as I indicated. Now they want to expense it. If you understand this part, you will never struggle dealing with these type of questions. So initially, they were capitalizing it. So I've explained what capitalization means. It means then they were increasing their asset base by the interest amount. Now they want to expense it. So in other words, what I'm saying here is they are decreasing their asset, which is the statement of financial position, and they are increasing their expense. You'll see soon when you go to the to the calculations. Then they gave us information about the dividends and closing retained earnings 2018 and 2017. Like I said in the previous class, know how to calculate retained earnings. Also, you should be able to see which information is provided, which information is missing, so you can solve for X. Here we're given closing retained earnings for 2018 as well as 2017, and if you can look, our year end is 2019. That means we need to calculate the closing retained earnings for 2019. Tax rate 30%. Now let's go ahead and analyze that information. Additional information number 2, change in accounting policy. This is straight from the scenario which I just read. Say during the current year, the company changed its accounting policy with regard to borrowing cost from capitalization of borrowing cost on qualifying assets to benchmark treatment of expensing borrowing cost. This gives reliable and more relevant information. So initial, it was capitalization. Now they want to expense. As I was indicated, capitalization has to deal with the asset, and expensing is interest that goes to the statement of profit and loss. So in other words, our asset needs to decrease and our interest needs to increase. I haven't seen anyone asking the question. If you have any question, you want me to repeat any part that you didn't understand, you're more than welcome to type it on the chat. All right. Nevertheless, let me continue. But if you feel that there's something you want me to repeat, type it on the chat. So let's deal with the information that is given. This information was given to us, change in accounting policy, borrowing cost. I spoke about the assets. Let's start here. I said decrease in assets. Don't worry about the figures. I'll explain the figures now. Decrease in assets. Why am I saying it's a decrease in assets? It's a decrease in assets because now they're no longer going to capitalize that borrowing cost or the interest on the borrowing cost. They are going to expense it. So in other words, this will lead to a decrease in assets. This is in relation to borrowing cost because I said borrowing cost, you borrow money to build those big projects. Right? So in other words, now you're no longer increasing your assets with the interest that has been capitalized. You are decreasing it with it. So it will be a decrease in assets. And a decrease in assets will lead to a decrease in tax. Very important. A decrease in assets will lead to a decrease in tax that you're going to pay. And a decrease in assets will also lead to a decrease in equity. If you can, for those who attended the class on Monday, who were dealing with inventory, and inventory increase, and I said, when inventory increases, your tax also increases, and your retained earnings or your equity also increases. So here's the opposite. You're dealing with an asset. A decrease in asset will lead to a decrease in tax, will also lead to a decrease in equity. This is very important, especially when you're dealing with a note. Then I'll explain the figures now. But if you understand this part here on the left, on the left of our screen here, if you understand this part before we even put any figures, because figures will always change. When you go to the next question, figures is going to differ. But if you understand the principles and the guidelines behind, you will never get it wrong. So it's a decrease in assets because it's no longer going to be capitalized, it will be expensed. So a decrease in assets. A decrease in assets will lead to a decrease in tax, also lead to a decrease in equity or in retained earnings. Now, let's deal with the figures now. I'll go back to the required, to the information provided, not the required, the information provided. So we are interested in the interest capitalized. That's what we're interested in. So in 2017, then that means our assets need to decrease by 160,000. When it comes to 2018, we're dealing with the item asset which is disclosed on the statement of financial position. Think about it this way. If in 2017 you had 160,000 to the value of assets, and in 2018 you need to decrease another 110,000, you must add the two. That's how we get the carrying amount of the asset. So in other words, in 2018, your asset is going to decrease by 160,000 plus 110,000. It's cumulative balance, so you add it together. I hope this makes sense. Think about it this way. If you have a motor vehicle in 2017 and you paid 100,000, and when you go to 2018, you have an addition of 100,000. When I ask you what is the total value of your motor vehicles, it is 200,000. Remember, you are adding it. It's not like expenses. Statement of financial position, assets, you add cumulative balance. So what I'm trying to explain here is that a lot of students I've seen they make mistakes, or they don't understand when it comes to the cumulative balances. In 2017, we all agree that our assets is going to decrease by 160,000. So when it comes to 2018, you add 160 plus 110, which will give you 270,000. So when it comes to 2019, you apply the same principle. So you're going to add 160 plus 110 plus 168. Let's see it here in the calculations here. Let's see it here in the calculations here. So in 2017, 160,000. There was no other value before that. In 2018, 270. How do we get it? 270, 160 of 2017 plus 110 of 2018. So it will give you 270. 2019, we apply the same principles, then it should give you 438,000. So don't fall into a trap where you just go and take 160, 110, and 168 and you put it and say, these are my decreases. So it's a cumulative balance because you're dealing with the asset balance. And as I've indicated that a decrease in assets will lead to a decrease in tax liabilities. Our tax is at 30%. So if you take 160,000 multiplied by 30%, it's going to give you 48,000. You apply the same principles in 2018, you will get 81,000. 2019, 131,400. So that's how the tax is dealt with. The difference between the two will lead to a decrease in equity. 2017, 112,000, 2018, 189,000, 2019, 112,000. So here's the part I want to spend some time explaining. So how will this affect your equity? So your equity is going to decrease in 2018 by 112,000, and in 2019 it's going to decrease by 189,000. So if you go to the statement of changes in equity, these are the amounts you should be able to see as a decrease regarding the change in accounting policy. This is what I'm talking about. If I come to the statement of changes in equity here in 2018, here's the line item change in accounting policy. This is a decrease, this is a decrease. Remember, this is at the beginning. Hence the reason that the amount which is in 2017, which is 112,000, is the amount that we're going to disclose here. And then the 2018 opening balance 189 is going to decrease here. So make sure that once you do the calculation, you know where you're going to disclose your amount. That's all about the asset part. So now let's go and deal with the interest capitalized. I've indicated that that part is going to go to the statement of profit and loss. That means that our interest is going to increase. And interest, we don't use cumulative balance because all the account on the statement of profit and loss, we close them at the end of the year. So if you close the books of 2017 or 2018, you don't expect to see any balance. So in other words, this is how it works. The profit or loss you make on the statement of profit and loss, it is transferred to retained earnings in the statement of changes in equity. We can all agree with that. So in other words, no amount will remain on the statement of profit and loss. In other words, you cannot go and take revenue of last year and add revenue of this year, or expense of last year revenue. No, you don't do cumulative balances on the statement of profit and loss. You do cumulative balances on the statement of financial position. On the statement of financial position. So now, in 2017, now our interest is going to increase by 160,000, 110,000, and 160,000. So an increase in expenses will lead to a decrease in tax. You must know this relationship. Let's start here on the left side before we go to the amounts. An increase in finance charges is an expense account, will lead to a decrease in tax expense, will also lead to a decrease in profit. Spend some time if you don't understand this so that it makes sense. An increase in expenses will lead to a decrease in tax that you're going to pay, will also lead to a decrease in profit. All right, I'm moving along. I think I'll also explain that on Monday, that principles on Monday. So let's look at the third calculation. This one we'll deal with it next week because it has to relate with the change in estimate. I want us to look at this one. So when it comes to finance charges, we are given the amount of 200,000. Where do I get this amount from? Here's the amount. Finance charges 200,000. Yeah, it is given. And according to the change in accounting policy, I've indicated that it's going to increase our finance charges. So in 2019 by 168,000 and in 2018 by 110,000. So the total finance charges that is going to go to the statement of profit and loss that is required will be 368,000 and 310,000. That's how we got it. Now the question is, do you necessarily need to show this calculation on the table form, it's up to you. You can do it on the face of the statement itself, as long as we can see that this is your calculations. I'm going to say it again. Make sure that you label your information properly. For example, if you're dealing with required number 1, make sure you indicate this is required number 1, this is calculations. Required number 2, this is calculations. Because if we just throw everything, it's just right there. We don't even know which one is the calculation, which one is the required. Now, when we're marking your paper, we need to go and look, where is this 160,000 for change in accounting policy? You might not get any marks, so you're shooting yourself in the foot. Make sure calculation is clearly labeled and required is clearly labeled. So when you go to the statement of profit and loss, you should expect under finance charges to get 360,000 and 310,000. This has been calculated. Increased by change in accounting policy because a decrease in assets, which was capitalized, will lead to an increase in finance charges. All right. There is the solution. There's the 360,000 we're talking about and the 310,000. That's how it was calculated. So, but more importantly, I want to spend time here on the note. Normally, a note carries a lot of marks, but if you understand what you're doing, you can get all those marks. And it is also very important you indicate whether your assets is increasing or decreasing. If you do the calculations correctly and you don't indicate whether it's increasing or decreasing, you will get 0, which is painful because after the hard work of doing all the calculations and you only go and you don't indicate whether what you're dealing with is increasing or decreasing, you're not going to be awarded any marks you want. So let's look at the note of change in accounting policy. This is where I keep on saying there are easy marks here. There are easy marks. The nature of change, by just you indicating why you're changing your accounting policy, you need to indicate that to the users. So what do you get there? So you will see that the year, they're just indicating to you that during the year, the company changes accounting policy from capitalizing borrowing cost to qualifying assets to expensing the borrowing cost as they incurred. This information is provided to you on the question. This is the information here. It is given as this. So you just need to know where to disclose it. It is disclosed on the note of change in accounting policy. There are marks for that. And if you don't do that, you miss those marks. You're not going to get any. Even when they say 5 minutes left or 2 minutes left, and you starting with a note, you can go and write this and you still get some marks out of it. So coming back to the note, again, they say this will give more reliable and more relevant information. This information comes straight from the question itself. This one, you must know it by heart. The change in accounting policy was accounted for retrospectively. This is not from the question, but you must know it. I've shown you on the principle as to all accounting policies must be accounted for retrospectively. And the comparative amounts must be restated. What does that mean? I've explained that if you have 2020, you must go to 2019 and 2018 as well. Here it was 2019, 2018, and 2017. So you must go to the relevant years as well. The effect of the change in accounting policy is as follows. The effect is going to affect the statement of comprehensive income as well as the statement of financial position. Why? Because we have an expense in the form of finance cost or interest capitalized, and we have an asset which was capitalized. So let's start with the asset. I've already explained the calculations. So a decrease in asset, I'm going to emphasize this. If you don't indicate that it's a decrease or increase, think about it. On your calculation, you say your asset is going to decrease. If you come here and say increase in assets, you're getting 0. You're not going to get any marks. That means you don't know what you're talking about. Whatever you put on your calculations, you should transfer it as it is. Why you should do that? Because we might penalize you on the calculation that no, you didn't get it right. It was supposed to be increased. But if you come and disclose it as it is, and if you are marking and it's a principal mark, we're still going to award you. But if you don't do that, you're not going to get any marks. So, but my emphasis is here is that tell me, is our assets increasing or decreasing? That's what we want to know. And in this case, the assets is decreasing. And you don't need to memorize this thing. You could get a borrowing cost going the other way around where the assets is increasing and the expenses is decreasing. So it is for you to read properly as to what are they changing from to what. You can get the next question where they say they were expensing it, now they're capitalizing it. So that means your asset is going to increase and your expense is going to decrease. But in this case, they say they were capitalizing it. Now they are moving to expensing it. So the 430,000, I think I've explained it enough on the calculations and the 270. And that will lead to the SARS and the retained earnings, which we just spoke about it. All these amounts are there on the calculations. They even show the calculations on the face. It's up to you where you want to show them. You can show them separately. You can show them here. The effect is the same. It depends on what you prefer. So let's look now at the expenses. Our expenses is going to increase in 2019 and in 2018. And as I've indicated, an increase in expense will lead to a decrease in tax expense and will also lead to a decrease in profit. All this information, they're just disclosing it. It is based on the calculations that we did. Any questions? Any questions? I'm not seeing any question in the chat. So does that mean that you guys, you understand everything we're doing? Any question? Guys, we're almost done. Change in estimate and errors, we're dealing with it next week. And by next week, we'll be done with this topic. So this is the opportunity for you guys to ask questions. I know this relates more or less the same as the inventory valuation in terms of the principles, though the calculations differs because on inventory, we're dealing with an asset as inventory and also dealing with cost of sales. Today, we're dealing with the interest for borrowing cost as well as the asset part of it. Any questions? All right. If there is no questions, that concludes today's session, which was very short. And next week, we are going to finish this topic. That's all about borrowing cost. I'm here. You can type a chat, you can type any question, anything you want me to repeat, I'll repeat it. So this is your time now. Put it there on the chat. I'll be waiting. Otherwise, then this is the end of our class. I'm still waiting for the question. I'm not seeing anything on the chat. Does that mean you guys, you understand what we're doing?
So I did send something on the chart.
Oh, you said something on the chat?
Yes.
Oh, all right. Let me quickly check that. I'm not sure if I'm. It's fine. Just use the mic. I'm sorry about this. Just use the mic.
Oh, so
how
do you calculate thereby what do you call it? Solution required 1. How do they calculate other operating expenses?
All right. I said, well, you don't need to worry about that. We'll attend it to it. It's with regard to change in estimate, which we'll do next week.
Oh.
Yes. It's just that the question that I selected, it has change in estimate together with the change in accounting policy.
Oh, okay. No, I understand, sir.
All right, you're welcome.
Okay.
Any other question? I'm still here. Okay, let me ask this, guys. Do you understand what I was talking about? Do you now understand change in accounting policy, borrowing cost? The answer is very simple, yes or no. So if I give you another question, a different question, we'll be able to treat it and deal with it. Okay. No one is responding, so I'll assume that you understand it. Guys, you're going to write and a test. This is going to be tested in the final assessment or final exam. This will be tested as well. So it is very vital that you understand whatever we're doing here, or you go and redo. So I believe by next week we're going to give you the question bank with various questions, prior exams, prior tests, and other questions, so that you can work through it with regard to this topic. And I think we're also going to upload the videos explaining these principles as well. So that will be next week. So once it's uploaded, I'll let you know, guys, that no, the question bank is there and the videos are there. So that at any time, if you're not sure of certain principles, you can go back to the video and check the video as to how do we apply certain principles. Or you can go back to the recordings that we have in here and you can go and just listen to that part.
So you're going to explain change in accounting policy next week?
No, change in estimate and errors.
Oh.
Okay, this is what I'm saying. So this topic, as I've indicated, it has 3 parts, right? It has changes in accounting policy. That's what we dealt with it today as well as last Monday. Next week, we're dealing with estimate and errors. And once we dealt with that, then we're done with the topic.
Oh, okay. But, all right. But sir, I have another question. If it, I'm just checking here on the calculations. I think it's 1.2. The change in accounting policy continue. Is it the continue of 1.1?
Oh no, it's fine. I'll resend the whatever I've uploaded now. I think there was some error on that one. I'll resend the correct one now, the one that I was presenting via the class rep. Yeah, you can discard that and use this one. I think the changes is very minor. There's certain page that was just need to be taken out. Is it related to the cost of sales, right?
Yes, it is.
Yeah, it needs to be out. I was just using the same information. That needs to be out because here we're talking about borrowing cost, not inventory.
Oh, okay. Thank you so much, sir.
All right, thank you for that. I'll resend this right away after the class to the class rep, so you can discard that and use this one.
Oh, okay, thank you.
So I understand the class was very short, right? Because we dealt with most of the stuff on Monday. It was just finalizing the change in accounting policy on the borrowing cost. Most of the stuff that we're dealing with today was just we're repeating what we did on Monday. Next week, estimates and errors. And this topic will be done and dusted with it. Thank you guys for coming, and please tell your friends that we started, those who are not aware, so that by next week they can join us, and also so that they can catch up on the recordings.